Imagine you want to invest in real estate, but instead of buying a house, you buy an empty dirt lot. You hand over your money and hope that someday a thriving neighborhood gets built right on top of it. In the investing world, we call this blind pool risk. It happens when you give your money to a fund manager without knowing exactly which companies they are going to pick. You are buying the empty lot, trusting their vision. Look at this chart plotting an investment's value over time. Notice how the line actually dips down below where we started before it ever goes up. That dip represents the early years of your investment, where your money is paying for management fees and initial business costs before any profits are made. Staying in that dip requires a lot of patience. Your money is locked away, and it can take several years before those early-stage companies actually start generating a return on your investment.
So, going the traditional route means locking your money away for a long time, based entirely on the trust that someone else will build a successful business from scratch. But what if you didn't have to start with the empty lot? Imagine if you could buy a house that already has a foundation, walls, and a roof, from a seller who simply wants to move out early. This is exactly how the private secondary market works. It is a space where new investors buy shares of existing private companies directly from the original investors or the company's employees. By stepping in halfway through the process, you skip those unpredictable early years of a company's life and invest in a business that is already standing on its own 2 feet. You might be wondering why someone would sell a successful business before it goes public. Usually it comes down to a need for cash. Original investors or early employees might want to buy a house or pay for college right now. Because these shares aren't traded on a public stock exchange, they can be harder to sell. To attract buyers quickly, sellers offer a reduced price. On the left is the company's official share price, the net asset value. On the right is the lower price you pay. That gap between the official value and your discounted purchase price gives you an immediate financial advantage, capturing built-in value on day one. Plus, since the company has been operating for years, you get to review their actual financial records and customer data. You aren't guessing based on an optimistic presentation deck. You are looking at real historical performance. Buying this way shifts your advantage as an investor. You move away from speculating on what a startup might become and focus instead on verified data and capturing immediate value. Right now, there is an unusually high number of these opportunities available. Recent high interest rates have caused the economy to cool off, which means fewer private companies are taking the leap to become publicly traded on the stock market.
When companies delay going public, early investors find themselves locked out of a traditional exit. Instead of cashing out after a few years, their money gets stuck inside these private companies for a decade or more. As those early investors lose patience and look for other ways to get their cash out, a massive supply of private shares floods the market. A stalled economy might sound like bad news, but for a prepared buyer, it creates a specific window to purchase strong assets from highly motivated sellers. Of course, a discounted price always comes with trade-offs. To buy safely, you need to understand the structural risks you are taking on. The biggest is liquidity risk. If you suddenly need your own cash back, you cannot simply click a button on your phone to sell your shares. Finding another buyer in the private market takes time. There is also capital risk. While you avoid the earliest startup hurdles, even mature companies face intense competition and can fail, meaning you could lose your original investment. Finally, certain deals carry funding risk. Depending on how the purchase is structured, the company might require you to inject additional money at a later date to keep your shares valid. In the secondary market, you trade the risk of the unknown for the risk of your money being tied up longer than expected. Professional investment firms know exactly how to manage these specific risks, and you can use their exact playbook by following 3 clear strategies. First, never invest cash that you might need to pay next month's rent. Keep a flexible reserve of money on hand so you can comfortably handle any unexpected requests for additional funding from the company. Second, professional investors split their money into different slices. Instead of putting all their cash into a single tech company, they spread it across various industries and growth stages to cushion against any single failure. Third, never handle the paperwork yourself. Professionals use regulated technology platforms to verify the shares are authentic, handle the legal transfer, and protect against fraud.
Applying these rules takes the guesswork out of the process, turning what might feel like a gamble into a structured, reliable way to invest. Ultimately, the secondary market offers a very clear proposition. You get to skip the unpredictable early years of a company's life and buy into mature, operating businesses at a discount. To capture that value, you simply have to bring patience and financial flexibility, holding on to your shares until the company eventually sells or goes public. For decades, everyday investors had to sit on the sidelines waiting for a company to arrive on Wall Street and start ringing the bell before they could buy in. That is no longer the only path. The private secondary market gives you the tools to access high-growth companies on your own timeline, giving you a powerful way to put your capital to work.